Welcome to Chapter 19. Chapter 19 has to do with what is referred to as derivative securities. So what is a derivative security? Derivative securities are things like calls and puts, forwards, futures, options, convertible, bonds. So not all of them are listed in the learning objectives, but they're different than what you've taken before or likely taken before. So what is an option? An option gives the holder of the right gives to buy an underlying asset. So it's like you haven't committed to buying it, but at some point, if you want to, you can buy it at a preset price, no matter what the current price is. So somebody gives you the option to buy a share at $50 a share. And if the market price is below the $50, you just buy it in the market. But you'll never have to pay more than 50 for the share until the call option expires. And so if the share price goes up to 61, you can buy the share for 50. A put is the right to sell the asset. So it's the opposite to a call. And the underlying asset can be anything. It can be commodities such as beans, corn, currency, bonds, stocks. So it's quite flexible as to what an option is. The excise or strike price or exercise, I guess, is the preset price which the asset can be bought or sold. Premium is obviously the option which is bought or sold, and of course that would be above. The intrinsic value is the minimum value. The intrinsic value is the cash value. And the difference between the what it's selling for in the market and the intrinsic value is the speculative premium, because you're expecting perhaps something to go up. So if you bought a house for $400,000, but you paid $410,000 for it, why would you do that? Well, you would do that if you felt that, say, fairly soon, if housing prices are increasing significantly, you would pay a premium for it, and you would expect that maybe in a year and a half, it might be selling for $450,000. So you're giving up part of that future gain. And that has happened in markets, housing markets in Canada, happened in Calgary, where people were paying actually above the asking price. But then 6 months later, the house is worth, the $400,000 house is worth $450,000. So here's just a graphic representation of calls and puts. When you have a convertible bond allows the bondholder at their discretion to convert the bond into a certain number of shares. So it's considered to be a positive from the bondholder's point of view. If the shares are doing well, you can convert your bond into shares at a preset ratio and price. So in this case, the conversion ratio is you have $1,000 bond. How many shares do you get? 40, 50, 10? So it's the conversion is at the call of the person who owns the bond. They can switch it over to be shares when they want. So depending on what happens with the share price will determine whether you want to convert your bond. Because normally when you have a bond, you just get the interest. If the corporation does really well, you don't gain. So it's viewed as a very positive type of thing. The conversion price will be the price that you can convert the security, in this case the bond, into common shares at. The conversion value is the ratio times the market price of the common share. And we're going to do calculations on this, which will hopefully make it more clear. And of course, the premium, like premiums are, is the extra. So it's the difference between the conversion value and the market value of the security. So in this particular case, here's an example to try and make things more clear. In this case, the conversion ratio is 20 and the conversion price is $50. So you take the 20, multiply it by the 50, and of course you've got your $1,000. The common share price is currently $45. And so the conversion, if you were to convert your bond to shares, your shares would be worth $45 and you get 20 of them. So you have a value of $900, simply the 45 times the 20. If the current market price for the convertible debenture, which is like a bond, has some similarities to bond. If the current market price is $1,010, it means that the conversion premium is 110. It's the difference between the value of the conversion value and the current market price. The pure bond value, so that would be the value of just the bond by itself, would be $785.18. And you know how to calculate the value of a bond. They call it pure bond value. So that's just the value of the bond, including the interest and including the getting the maturity value back. The premium is the difference between the current market price and the pure bond value. So you can see that the bond just by itself is $785.18, but yet people are willing to pay $1,010 for it because of the convertibility feature, where you can convert it into shares, which means that you're expecting the shares price to go up significantly. Because why would you pay $224.82 above the true value of the bond, or the value of the bond just by itself? Now, why would a company issue convertible shares? Because it's a benefit to the shareholder in the fact they don't have to pay as much interest, because the bondholder says, well, this is a good deal. If the share prices are low, I'm going to keep my bond, but if the share prices go up, I can buy at that preset price and switch over to shares, so I can gain, but I won't lose. So it's called a sweetener. And so it lowers the interest rate. So the bondholder gains in the fact that if the corporation does really well, they'll convert to shares. And if the corporation doesn't do really well, they'll just keep their bonds. So they're protected. And the shareholders get a lower interest rate, which they like. So it makes the company more profitable. Now, if the share price goes up significantly or goes above the conversion price, the corporation loses because they could have sold the shares at the new higher price. So they'll actually lose in that regard. Now, warrants, you can see, is the option to buy a stated number of shares at a specific price over a given period of time. Now, there is an expiry on it, and you can sell the warrants separately. So that means if you've got 5 warrants, you don't have to sell it as a block of 5. You can sell them as individuals, or one at a time. So warrants are used for speculative trading. They have a tendency, they're called leverage, which means that for a small amount of money, you can make a large profit. The downside is, for a small amount of money, you can lose all of it. So if the stock goes up, you will gain faster than the shareholders. But if the stock goes down in price, you will lose faster. So that's where the leverage comes into play, and that is a higher level of risk. So here's the formula. We'll go through a calculation on it. Formulas are pretty straightforward. The intrinsic value is simply the market price minus the exercise price or strike price. And then number of shares each warrant entitles the holder to purchase. So that's not always a 1-to-1 ratio. Sometimes it's 1.5. Sometimes you have a warrant and you're entitled to 1.5 shares or 2 shares. So that's what the N represents. The speculative premium is the difference between the warrant price, what it's selling for in the market, and the intrinsic value. The intrinsic value, perhaps the easiest way to think of the intrinsic value, is the true cash value of the warrant now. And as you're well aware, when somebody is speculating, they're guesstimating or predicting. If they're willing to pay you a premium, that means they expect the share price to go up even further. So here's just a summary of rights, warrants, and convertibles. It just does a nice job of identifying the difference between them. We're not specifically going to test you on this. So if you want to kind of gloss over this or just take a quick look at it, that's all you really need to do. And that's the end of chapter 19.